Very good morning to all the participants and welcome to IVS session of this risk management. And whatever you have heard from Rabindranath sir, just forget that one. That is not material at all. What matters is whether at the end of this class session, how much we have understood. That is the thing. So those qualification and other things are very irrelevant. Anyway, I will try my best because I am taking classes for this risk management, balance sheet management for IBS for the last so many years, 4 to 5 years. So I'll be happy that whatever I know, I will make you understand in a very easier way. And first thing is that time is very short because this course is a crash course. So at the last moment, when the examination is just knocking at the door, you all have joined here. So that is not a matter at all. Everything we can learn from that. But I hope that those people who have joined for this crash course, they must have definitely read the book as well as other study materials, and for refreshing their thing, and they have joined it. So I will assume that you all know something about this risk management. So with this intention, we will start the class. This class is up to 3 hours class. So we'll start now, and exactly at 11:30 we had a break. We will have a break for 15 minutes, and 11:45 we will join back, and till 1:15 I will continue with the class for today. Next, tomorrow class will be there. So today and tomorrow, entire risk management has to be covered. Next 2 days, we'll have balance sheet management. So that is the agenda of this thing. So let's start. Okay. So today I will just try to cover 3 chapters of module B. Let's see how much we can go ahead. Okay. So I hope that you can see my shared screen. Can anybody just tell me by unmuting the mic that
Yes,
you are?
Yes, sir. Yes, sir.
Okay.
Yes.
Thank you. Thank you very much.
Yes,
Thank you. So anytime any question you want to ask, you can stop me anytime and just unmute your mic and ask the question wherever you find some difficulty. Otherwise, it will be always a decorum the class that you please mute your mic so that the background noise will not come. Okay. So when I am speaking, so your mic should be in the mute position. That will be the best thing. Okay. Thank you very much. So we'll start with the today's session. So what are the things we'll discuss right now? I have just listed out. We'll discuss what is risk, because it is about the risk management. So we'll discuss about risk. What is risk? General term, what is risk? Then we'll talk about what is financial risk, because entire thing is about banking. What is the risk in banking? That is called financial risk, because we are dealing with financial matters. So what is financial risk? What is the general risk and what is financial risk? Then we'll see what is a zero risk or risk-free investment in the bank. Then we'll look at the link between the risk, capital, and return. Then what is the basic risk management framework for banks? Then we can see what is the risk in the banking business, what are the risks faced by the banking business, and why this risk has to be managed, and what is the regulation as imposed by RBI in the banking industry. So before I go into all the things, the first and foremost thing, I will tell you that entire risk management, whatever we are going to talk now till the end of this module, the entire risk management focuses on only one thing. Just one thing it focuses. It focuses on one thing, that is called capital. What is capital? Can you just, before we begin the class, just I want to know, do you know about capital? What is capital? Why capital is needed? Anybody can answer me.
Start any business.
Okay. To start any business, you need capital.
Some source of fund at least.
Owner's contribution for business.
Very good. So this is owner's contribution. Very good. Owner's contribution. Why this is required? Owner's contribution is required. Why? Why owner's contribution is required? You must have.
For running the business.
Running the business, only owner's fund is required, or something else is required?
To overcome the risk.
ड्यू टू अगर आप दूसरों के पैसे से अगर आप ना काम करोगे तो फिर आप कभी बिजनेस छोड़ के जा सकते हो.
Okay, fine.
To-
See,
To
suppose
mitigate the risk.
mitigate the risk comes later on. That we'll discuss. But basic purpose. So, think. See, when you start a business. Yeah. When you start
the business, sir.
Okay. I can't hear you. Anyway, I'm just explaining. Suppose you want to start a business for which you need 1,000 rupees. Okay. Total fund required is 1,000 rupees, which entire business requires 1,000 rupees. Suppose you have 1,000 rupees with you, then you can easily invest that 1,000 rupees and start the business immediately. So that will be your capital. With total capital, you are starting the business. But sometimes it is not possible to have the total amount. Suppose it is not 1,000 rupees, suppose it is 1,000 crore rupees. In 1,000 crores rupees, suppose you don't have the 1,000 crore rupees of fund with you to start the business. But to start the business, definitely people who want that, you should have your money. You cannot start the business with entire money of outside people. That will be very dangerous, because outside people will tell that you are not investing your money, but you are asking us to invest money for your business. And if your business fails and you go away, so what will be, it will be totally our loss, no loss to you. So for any kind of business, suppose 1,000 crore is required. Suppose you have only 100 crore. So you want 900 crore. So that 100 crore investment from you, your own personal owner's contribution, that will be considered as the capital of your own. Rest amount you can brought in from other people. So entire fund can be brought, then you can start the business. So that is the thing. And always remember that to start the business, first thing required is capital. First thing required is capital. And when the business is running everything, the last thing which is to be touched is capital. While running the business, you cannot touch the capital. You have to go on working in the business from working capital or any fund you required, but your equity capital, you are not allowed to touch. So first thing is required in a business to bring in capital, and capital will be the final thing when the business is winding up, you are closing the business, that should be touched, that is capital. This much you should know. So because entire course, entire module will be on capital only, because risk management focuses on how to increase or strengthen capital. That is the only thing, strengthen capital. The entire risk management of financial industry or banking talks about how to strengthen capital. Once you have started the business, over the years, you have to build up your capital. You have to build up your capital. Capital should be growing as the business is growing. That is the basic thing we should remember, and we'll talk about this later. Okay. Now we'll discuss about what is risk. So basically, what is risk? Risk means, in literal term, if you look into dictionary, risk means running into danger. Risk means taking risk, means what? You are running into danger. So basically, literal meaning is run into danger. Risk is therefore a possible. Running into danger means always it is a negative thing. Danger means always there is a negative thing. Danger is not a positive thing. Danger means you think that there will be some kind of harm or injury, some kind of loss or something like that. Okay. So we should understand this. Everything we do in life, whether it's personal or professional, whatever thing, everything we do has got a action. So every action we do has got a reaction to it. Newton's law is there. So every action has a reaction. And when this reaction can be three-way. Reaction can be a positive reaction. Reaction can be a negative reaction. And reaction can be a neutral one. Neutral means there is neither negative nor positive. Normally, when we do some action, we do something, if the reaction is positive or neutral, we do not worry at all. We are not worried because we want to have some positive result. But when the action we did and the reaction is negative, then only we start worrying about this. So when this action results in some reaction which gives to some negative result, then only comes the risk. We remember the word risk because if the action we have done and reaction is a positive one, we do not remember risk at all. We do not think about risk. Risk comes into picture or comes into mind or any kind of thing whenever there is a negative result, negative reaction. Okay, so we can say that risk is therefore a possible outcome of a negative result of our action. So whenever negative result comes, we think that there was a risk, we have not taken care of the risk. Okay. So risk, we can say that it is an uncertainty about the consequence. Consequence is the outcome. This is the result, or consequence means result or outcome that may result in negative result. Simple. When risk means, risk is always uncertain because we do something. Our action, we do some action, we do not know what will happen, whether it will be a positive or negative, we do not know. So it is an uncertainty. We do not know the result before we do that. And whenever there is a result which is negative, then we call it a risk. If it is a positive, we forget about risk because we think that we have taken care of a risk. So risk is an uncertainty about the consequence that may result in negative outcome. Okay, so this is about the risk. So that means what? When we are doing something, when action is there, when reaction will be positive or negative, both can be there. So these actions which result in positive or negative, Mr. Sudhis, can you please mute your mic because background sound is coming. We do not know when we do something, we do not know how this result has become positive or negative. This might. Mr. Sudhis, can you just mute your mic, please? Okay, so this result, positive or negative or neutral, whatever, it may be the factors which gives into this result, it may be due to our own action, or the thing which are beyond our control. So there are some things which is beyond our control also that will produce this positive or negative action, more specifically negative action. Because see, suppose you are driving a vehicle. You are driving a vehicle with all safety and everything. You are obeying the traffic rule. Everything is there. You are stopping at the red signal. You are driving at 40 kilometers per hour. So you think that you are safe. There is no negative. But sometimes some things are there which is beyond our control. That means from behind one bus or truck or an auto or something, for their negligence, they will come and hit our vehicle. That is not our fault. So in that case, this negative result has come from those consequences which are beyond our control also. So it might be due to our own, but might be also some external factors. So it could be due to us or maybe due to actions which are beyond our control. So we can say that risk might be, in such cases, the result depends on our own actions or the actions due to some external factors or third party interference. So in banking, if we say we have to see, we get the deposit, we accept deposit from the public for the purpose of lending and investment. These are the three core business of banking. So while we accept deposit, our main purpose is to lend the money, because through lending we will get the maximum return. Because here we charge interest, we get the interest, and we have to pay the depositors. So in banking you have to lend, and this is you cannot forget that. You cannot say that I will not lend. If you do not lend, you will not get profit. So you have to lend, knowing the fact that when we lend, out of this, suppose 100 loans you have given, 100 numbers of loans you have, you know that some of the loans might be also turned into NPA. The borrower might default. So these things are inevitable. You have to do the business knowing that there is risk in the business. But you have to manage the risk in such a way that your returns are always higher. That is the basic. So question may arise, why some people are willing to take risk and where some people are not willing to take risk. Some people are always in the process of taking risk because they know that unless we take risk, we will not get the return. Because there is a principle that risk is directly proportional to reward. Risk is directly proportional to reward. Means higher the risk, probability of higher the return. Lower the risk, lower the return or lower the reward. No risk, almost no reward also. So always remember that this is not, proportional is not guaranteed. It is not guaranteed. It is about probability. Probability. We are not talking about guarantee that you are always ensured that high risk I will take and there will be no problem at all. I will get all the return immediately. No, it is not. It is probability. So risk is uncertain. So this uncertainty keeps such a thing which is called probability. Probability means there is a chance that you will get more, or you may get less, or you may get losses also. All the three things are possible. Okay, so more risk is taken by those persons in view of the fact that there is always a high underlying higher yield. Because this formula you remember, if you don't take risks, reward will be always less. So more risk is taken by some people for the fact that they know that there is a underlying higher yield in taking the risk. Okay, but somebody may ask, are there any practical ways to cope with this risk and get the desired return? Get the desired return, always to manage risk and get the maximum return. It is not always possible, but definitely it is possible by managing the risk. That's why this risk management concept has come. This is done through risk management. So we'll talk about all these things together. I hope you understood the concept of risk. Okay. Now we can say that finally risk is the negative deviation. When this negative result is coming, so it is a negative deviation in what we achieve from what we have planned or what we have expected. Means in banking terms, suppose you have targeted for the next year that you will have 100 crore of profit, rupees 100 crore of profit. Your target is 100 crore. So after the year is ending, either you will achieve 100 crore, one possibility that you can achieve 100 crore or even more than 100 crore, or second possibility that you may achieve 80 crore, or third possibility that you may have loss of say 10 crore. Three possibility I am giving. One is positive, this is positive, this is little bit less. We can say that we have not achieved our target, but less than that, or we might have a loss also. So all three cases, when we achieve this one, we forget about this. there is no risk. But when our target is not achieved, when it is 80 crore, that means there is a negative deviation. Because our target was 100, deviation has become, negative deviation has brought it to 80 crore. Or it is a total loss. That is also a negative deviation. So risk is the negative deviation in what we achieve from what we had planned or what we had expected. Because we had expected 100 crore, but we have landed with 80 crore or 50 crore or minus 10 crore. That's a loss also. So either the profitability has come down or it is a outright loss. In both cases, we can say that there was a risk. Okay, clear up to this? There is no problem. So I'll go to the next. So always, there are always two probability out of risk, as we have already discussed. Risk has basically two probability. Either you gain or you will lose, positive or negative. In business, either the profits, in business, while doing the business, either the profit and capital will grow when you gain in the business. In that case, what will happen? Either the capital and profit, they will grow year by year. When your business is growing, they will grow multifold, or the entire business may be wiped out. Entire business might be wiped out due to continuous loss. So in that way, what will happen? Entire business will be closed. Nevertheless, when we are in the banking business, we can never be risk-free. We cannot be risk-free. We have to accept the deposit to lend to people. Lending is the basic core business. Without lending, we cannot earn. So we cannot be risk-free, or we cannot be risk-averse. Risk-averse means somebody tells that, no, I will not lend any money. A branch manager is there, he says, no, I'm afraid of my career, I will not lend money. So he is not a banker at all, because you have to lend money. Without lending, it is not possible. So risk is the adverse deviation in what we achieve from what we have planned or expected. Okay, so next we'll see that already we can agree that future is unpredictable. Okay, so why this unpredictability? Because we do not know what will be the result. The result might be, this unpredictability is due to two factors. One is uncertainties, second is external factors. Uncertainties means what? Uncertainty means, as this is associated with the steps we have taken, all the steps we have taken to do that thing that we undertake in the process, or due to some external forces which influences our banking. Like I told you, you have driving, somebody hits you, it is not your fault. So in banking business, we do not know what steps you are taking while lending or investment or taking deposit, what steps you are taking. So everywhere there is uncertainty. Second thing is that external factor, maybe due to not our fault, but somebody else's fault, there might be a loss also. So uncertainty resulting in adverse outcome. When we talk about this adverse outcome is negative result, outcome. Adverse outcome, when we talk about adverse in relation to what? In relation to our planned objective. Our planned objective was to have 100 crore of profit, but our expectation was that, but we have landed less than that. Okay, suppose, I think it is clear to you. Should I explain more, or this is the fine for you? Can anybody tell? Is it okay?
Fine, sir.
Yes, sir. Fine. Okay.
Okay, sir.
Okay, so we can say that it is a risk only when the uncertainty results in adverse outcome. Simply, when negative thing or profit has come down or loss, then we will talk about risk only. Then an adverse outcome as regards to our plan, objective, and expectation. Now we'll see what is financial risk. In banking, what is the financial risk? Financial risk is, in banking we do, financial risk is, as I have already told, it is the probability. Always risk means always there is a probability. Probability. Always it is probability. It is not guaranteed at all. There might be yes or no. plus or minus. Financial risk is the probability that the realized return, the expected return, okay, expected return, realized return would be different from our target one, target or planned one. We always plan for our entire business. Our bank plans for the next year's target. What should be our advances? What should be our deposit? What should be our investment? What should be our profit? These are the four basic things we always do. So whenever basically entire thing we are doing in the business to earn profit only. Without profit, it is very difficult to run the business. So our ultimate aim is to profit, earn profit and grow the profit, enhance the profit. So we may say that financial risk is the probability that this return, expected or planned return, would be different from the anticipated or targeted one. Okay, so we can say that uncertainty, financial risk is the uncertainties in adverse variation of profitability or outright losses. Adverse variation, I have told you, 100 crore you have decided to have a target. Either you have achieved 80 crore profit or you have a loss of 10 crore. Both way, it is adverse variation because your target was 100, which you have not achieved. Similarly, now you are preparing for CAIB. So CAIB, your target is to score at least 50 plus mark to pass CAIB. If you score 50 plus mark, then you say that, yeah, I have managed my risk, everything I've studied and I've passed it. But if you land up at 49 or 45 or say 25, both way you have adverse variation of your target result. So that is your risk. You have not managed the risk properly. That's why you have deviated from your target. You could not achieve 50 plus. So this is what financial risk. Financial means any adverse variation of profitability, means 100 to it is coming less, or outright losses, or straightway you are losing. So those both are considered as financial risk. So financial risk is the probability that the realized return would be different from the anticipated or expected return on the investment which I made. Investment is our capital and all the funds we are utilizing. So when it is not giving us the anticipated result or target result, we call it as a financial risk. This is a simple thing. Because why I am narrating all these things, and those things which are marked in highlighting in a red ink, please do write those things, because those are meant for some MCQs. My theoretical MCQs come for those things. Okay. So now, what is financial? So profit or loss on the business depends on the total business we are doing. Any kind of business, it depends on the two factors: cash inflow and cash outflow. So whenever the business starts, which one first happens? Cash outflow or cash inflow? Whenever
Cash inflow. Cash inflow.
okay.
Cash inflow.
Okay,
Cash
so
inflow.
cash inflow will be what? Your capital. Capital and other funds, it is coming. Then you are using this capital to run the business. Then outflow will be there. Then again, outflow means you are utilizing this. After the cycle, again cash will be a inflow. So basically, there will be a cash inflow and outflow. Inflow and outflow has to be there in the business. And the profit and loss comes from the difference of this cash inflow and outflow. So net cash flow is cash inflow minus cash outflow. Do you get it? So net cash flow, when we consider what is the net cash flow, that formula is what is the amount of cash inflow and what is the amount of cash outflow. So we have, suppose cash inflow is 100 and cash outflow is 80. So what is the net cash flow? Net cash flow is 20 positive. Positive. So in that case, when this is positive, we say this is a profit. Suppose cash inflow as 100, a cash outflow as 110. So it is a negative. So this is a loss. Simple. So you can say cash inflow, whenever cash inflow is greater than cash outflow, we arrive at profit. And whenever cash outflow is more than cash inflow, it becomes a loss. Clear? Simple exercise you can.
Please mute.
Friends, I've told you.
Host can mute all, sir. Host can mute all.
Host, I'm not the host. Biju, can you see? So basically, we have arrived at this cash inflow. When cash inflow is more than cash outflow, we have profit. When cash outflow is more than cash inflow, we will eventually result in the net cash inflow that will be decided. If net cash flow is positive, we have profit. If net cash flow is negative, we have losses. This is simple formula of business. Okay. Now, what is the possible, as we have already understood, that the possible adverse impact in the business due to risk is called risk in business. Adverse impact means, as I told you, profit will be coming down or we have loss. Either profit will be coming down, profitability comes down, or you have loss. Those are called adverse impact. So this adverse impact is called risk in business. I mark in red ink because sometimes MCQs comes. What it is called, what is the possible adverse impact in business is called. So we can say that it is a risk in business. Okay. So similarly, the factors that are responsible for creating uncertainties in cash inflow and cash outflow are called risk elements. The factors which are responsible for creating. So we know that cash inflow is there, outflow is there. So this inflow and outflow, when you net together, we are getting net cash flow. So whether the net cash flow will be positive or negative, that depends on some factors we have discussed. These are called risk factors. So this factor will decide whether the net cash flow will be positive or negative. So this factor which decide the positivity or negativity of the net cash flow are called risk elements. So whenever a question comes, what is the risk elements? You can say that these risk elements are the factors which actually result in the uncertainties in the cash inflow and cash outflow or the net cash flow. Then what is high risk business and what is low risk business? We should know high risk business. So some business are called high risk business. Some business may be low risk business. Means the risk in the business is high and risk in business is low. Okay, so how we'll know that whether this type of business are high risky or you have taken high risk or you have taken low risk? It will be decided from the variability of the net cash flow. Net cash flow. So net cash flow is the final result we are getting, whether it is be positive, how much positive it is there, and how much negative it is. Impact of positivity or profit or impact of losses. How? So variability in net cash flow is high, which is when it is high, it is favorable. It is called a favorable situation. It may result in higher profits. When the variability in the net cash flow is less, this is called adverse situation. This is favorable, this is adverse. Favorable situation, higher profit. Adverse situation, higher risk. Such businesses are called high risk business. Means in high risk business, there might be higher profit or there might be higher losses, both together. So high risk business will result in higher profit or higher losses also. Similarly, low risk business will give in lower profit and lower losses. So for that reason, we can conclude here that for high risk business, for this purpose, since the range of profit and losses are always high, we want high capital. So capital requirement will be high. Similarly, for low risk business, since the range of profit and losses are less, so we require less capital. So these are the equations we should know. So high risk business implies it will get higher profit or higher losses, and for that purpose we need higher capital. Lower risk business implies low profit or low losses, and we require less amount of capital in comparison to high risk. So that is called, see, this range of profit and losses, what is there, how much it will be range, they are called, when is the range is higher, that is called upside potential. That is called upside potential, means there is a upside potential, higher profit is probable or we can achieve. There is a potential that higher profit can be achieved. Similarly, when there is a maximum loss, those are called downside potential. So we can say that high risk business has got a very extreme range of upside potential and downside potential, and low risk business has got a lower upside potential and lower downside potential. You have to remember these terms because in MCQs, everything this might come. Any doubt about this? You can just ask me, otherwise I'll go ahead. Okay. So higher risk would imply higher upside and higher downside potential. Lower risk will imply lower downside and lower upside potential. And for that reason, higher risk business requires what? What is required? More capital. Higher capital is required for higher risk business. Low capital is required for lower risk businesses. This is the equation you have to remember. So we have discussed about high risk and low risk. We have discussed what is risk in business. We discussed what is the risk element. Now we'll see, as I told you, there are three factors. One will be positive, one will be negative, and there might be neutral also. So that neutral thing in risk management, we call it risk-free or zero risk. So there is a thing called a risk-free or zero risk. Actually, in banking business, we call it zero risk, risk-free, but actually it is not so. It is, can be said that it is the least risk. You know, nothing in the banking business can be a zero risk or risk-free. So zero risk means what? Zero risk means what? No variation in net cash flow. When there is no variation in net cash flow, that business can be called as risk-free or zero risk business. What can you give me an example of any banking thing where there is no variation in net cash flow? Can anybody give me any example? Any kind of banking business we are doing where there is no impact on the net cash flow for a customer? Anybody? Can you just tell me? You can just tell me in the chat box. No? Okay, I'll let you know. Suppose a person comes to you and he wants to have a fixed deposit with you, with your bank. So 1 year fixed deposit. So he keeps 1 lakh rupees. 1 lakh rupees for 1 year period. Say you pay interest rate 6%. So 1 lakh his capital he has invested, and he is earning 6% per annum. So per annum he will earn 6% only, whether it is a annual interest or half yearly or quarterly, whatever he wants. So it means what? For 1 year, he will get this 6%. 6% means how much? 6,000 rupees he will get. So this 6,000, suppose he wants it once in a year, and at the time of maturity, he will get 6,000, or he wants it, say, quarterly, say 1, 2, 3, 4, 4 quarters he wants. So you have to pay quarterly, so 1,500, 1,500, 1,500, 1,500. So these are the cash flows he's getting, his investment, he's getting cash flows, this one. So when these cash flows are constant and not varying, then we can say that there is no variation in net cash inflow. So when this is not varying, we can say that this is a risk-free or zero risk type of thing he has done. So in banking, a return on the zero investment would be always less or low as compared to other opportunities available in the market. So basically, when we talk about this, we can say someone invests 1 lakh, say already I have given this. Suppose, again, I am discussing this one, 1 lakh in a FD or government bond, say, so either a bank FD or a government bond 5 years, where the agreed rate of interest is 6.5%, which is payable half yearly. Okay, so in this case, what will happen? He or she would be receiving interest of 3,250 every half year for a period, say every half year for a period of 5 years, because his investment is fixed for 5 years, and finally he will get back the principal after the maturity. So here the cash flow does not vary. For 5 years, he will be getting this 3,250 every half year. There is no uncertainty at all in this cash inflow. So these can be called as risk-free or zero risk investment. And such type of investments, as I told you, always return on this zero risk investment or risk-free investment will be always low. It will be always low as compared to other opportunities available in the market. That means, suppose a person is investing in this government security of say 5 years with a return of 6.5%, he will receive this interest every half year. But somebody else may invest in, say, some other bonds or maybe in share market, where the volatility of share market, the price is very high or very low. According to that, his profit will be either much higher or he may lose also. So in this case, these are called risky investments and these are called zero risk investment. So this is a difference between what is the riskier investment and what is the zero risk investment. So always remember this one, return on the zero risk investments would be always low as compared to other opportunities available in the market. Clear? Okay. Next we'll see. Suppose example I'm giving you. Why this risk comes? Suppose there are 2 types of investment given to you. Say you are going to invest in something. Say you want to invest in say some 1,000 rupees or 50,000 rupees. So there are 2 options given by the issuer. Investment 1, investment 2. Investment 1 says that both are 5 years. Says that we will give you 10 rupees every 10% every year till 50 year. So you will get 50 rupees. So 10 rupees, so 50 rupees will be the return from it. And you will get back your principal. Second investment says that first year will give 9 rupees, second year will give 10 rupees, third year will give 13 rupees, fourth year there might be a loss, and fifth year might be 21, but total will be 50. So basically, when such 2 investment given to a single person, definitely he will look at the what is the return first. When returns are same, both the things, he will say that it is better to invest this one because it is safer. Because I will be the cash inflow for each year 10 rupees. That is assured for me. So why should I invest in investment 2? I will invest 1 only. Is it not? Because I know that 10%, say 1 lakh I have invested, so 50,000 I have invested, so 10% I will get every year. So better to here. Why should I invest here? There is a possibility that here no return will come in this year. Other year higher return, but I may need this year also some inflow needed. So I will not go for this type of investment. I will go for this type of investment. This is because of the fact that here there is a steady stream of cash flow which is associated with the investment. Investment 2 will not be preferred by me. But now I will give a third option. Suppose I will give this option, investment 3, where the investments are fluctuating every year, but at the end of 5th year, instead of 50 rupees, you are getting 53 rupees. So if this option is given, then definitely I will shift from investment 1 to investment 3. Why? Because investment 3 will be preferred by me because there is a return of 53 rupees against 50 rupees. So I have a plus 3 rupees extra return. So this plus 3 rupees is how much? This is 0.6%. Earlier you are getting 10%, now you are getting 10.6%. So this 6% additional return you are getting, that is attracting you to invest this one. So this is not a zero risk investment. This is a zero risk investment. This is not a risk free or zero risk investment, but still you are opting for this one because of there is a extra return of this. This extra return, what you are getting is 0.6%, is called the risk premium. This is the premium which is paid for taking the risk. So you have taken the risk to invest this one because there is a probability that you get more return, and that return, extra return, is called risk premium, or it is also called the cost of risk. Because you have opted for a risky one, there has to be a extra cost which should be rewarded to you. So this extra, if it is not given, you will not invest this one. So basically, in case of investments, always people do that because higher the risk, higher will be the premium. So this premium, risk premium, always decided on a simple factor: higher the risk, higher the premium. So you consider about any health insurance policy you are taking. In the bank, you have your own health insurance policy. But suppose you take a health insurance policy for your own brother or father or somebody externally without taking the bank. So in that case, what will happen? Whenever the risk amount, suppose you go for a 4 lakh policy. 4 lakh policy, the premium will be say 30,000. So when you increase this 4 lakh to say 8 lakh, then definitely the premium will be higher. It might be 45,000. So it means that to get the maximum benefit, you have to pay a premium. Same thing applies to these things. When you are taking a risk, you are applying for an investment which is risky. Definitely you are going to that because there is always a underlying risk premium which will be higher. So this is called risk premium or cost of risk. If this is not given, people will not invest in such type of investment. Is it clear to you? Is it clear so that we can go ahead? Okay. Now we'll see what is the linkage between risk, capital, and return, because these three are the most connected ones. We have talked about capital first, and we have talked about business, that is a return. Return is nothing but profit, and every business has a risk. So what is the link between these three? These are the basic things should be known in risk management. There is a linkage between risk, capital, and return. Okay, so minimum. So before I tell about the thing, the linkage between risk, capital, return is that you need capital to start the business. You have to do the business because your motto is to, objective is to get the return out of it, maximum return. And while doing the business, you have to carry on risk. You cannot escape from any three of this one. You have to do the business to get the maximum return. To doing the business, capital is required and business has risk in it. So this is the three things are interconnected. And to run the business, as I told you, first thing is required is capital. Say I told you that you need 1,000 crore rupees for a business where your own capital is say 500 crore. Rest 500 crore, this is your own capital and this is your borrowed capital. You have borrowed from other people, either a bank or investor, whatever it may be. So you need 1,000 rupees, 1,000 crore, out of which your own fund is 500, you have borrowed and doing the business. Okay, so now this will be fixed as a capital. You cannot touch it. Other funds you can touch that one because capital is always kept separately until and unless it is required to be touched. As I told you, it will be the last thing to be touched. So similarly, in the banking business also, all the banks, they start with a minimum amount of capital, which is required as per the Banking Regulation Act. We have studied that in JAIIB, that what is the amount of capital required, 5 lakh, 10 lakh. For private banks, it is 500 crore, 1,000 crore, whatever it may be. So these are the capital. So this thing, the minimum capital requirement, MCR. So this is fixed as per Banking Regulation Act. You have to have a minimum capital requirement for a business should be such that, why this minimum capital required? This amount of capital is required for the fact that it will be able to meet the maximum loss, if at all you will face in the future. So minimum capital required for a business should be such that it is able to meet the maximum loss that may arise from the business, which would avoid, if you can have the capacity to bear this maximum loss, then you are able to avoid bankruptcy. So basically, the entire thing about risk management is to avoid bankruptcy so that your bank is not going to be closed. Because people's money is there, people's faith is there. So if your bank will go bankrupt, means people will lose interest in banking. You may be seeing 2-3 banks have fallen into that trap recently, and how this hue and cry people are going. So the minimum capital requirement is that capital which will be able to cover the maximum loss so that you can avoid bankruptcy. So that is what the entire thing about risk management. So as I told you, capital required for higher risk business would be higher, and because the possibility of higher losses are there, that's why you need more capital. Similarly, capital required for lower risk business would be lower because probability of lower losses is there. So this is the basic linkage between risk and capital. Risk and capital. What is the link we have decided? Simple thing. High risk business requires higher capital. Low risk business requires low capital. That is the link between risk and capital. This is the basic linkage between risk and capital. If the risk in business or investment is netted against the return, if the risk of the business or the investment, means capital of business, is netted against the return, return means profit. When you club together risk and capital with the profit out of it, that is called adjusted return on investment or risk adjusted return on investment, or we can say risk adjusted return on capital. So RAROC, this is the term you will come with. This is what the linkage is, that if the risk in a business or investment is netted together with the return from the business, it is called RAROC, risk adjusted return on capital, or risk adjusted return on the investment. So we'll see what is the thing. Minimum capital required for a business should be such that it is able to meet the maximum loss that may arise from the business, which way we can avoid bankruptcy. Capital requirement for high risk business will be higher and the low risk business will be lower. This is basic linkage between risk and capital. So if the question is what is the basic linkage between risk and capital, the formula is high risk business requires higher capital, low risk business require low capital. So as regards profit or loss, high risk business